So it's a bit of an humbling experience, sir, because from whom I took the baby steps in neurology, sir is sitting right there from SMS. So talking about investments and mutual fund in front of him is itself an experience. So a very good morning to everyone. So the next half an hour will be about mutual funds. So as in anything in medicine, we will divide this into principles and practices. So I will talk about what are the principles behind mutual fund investing, and the practices will be shared by Dr. Nishit Patel. So this has to be a mandatory disclaimer. We are full-time neurologists and just part-time teachers of finance. So I will try to justify this statement as sir said. It is just not for the cricketers but for neurologists as well. So what are mutual funds and how do they work? An investor will come with his money. Money will be given to the fund house. Fund house will appoint a fund manager. Then the fund manager, with all his experience, will invest the money in the securities, like stocks, bonds, and gold, and they will generate returns out of that investment. And investment will be the returns will be given back to the investor. This is the basic workflow of a mutual fund. Now, this is a very growing industry in India. More than 45 fund houses are already there in India, and they create all categories of mutual funds and various schemes. And we will try to navigate through all this and try to simplify it as far as possible. So what is the size of mutual fund industry in India? Currently valued at more than 60 trillion. So if you see from December 1999, the Sensex has risen to 80,000 and the mutual fund industry has kept pace with it. And probably the mutual fund industry in itself is responsible for the rise in Sensex because they are very adept at collecting money from investors and then investing in the market. So this is the basic method, systematic investment plan. Probably everyone has heard about it or invested through SIP in some or the other manner. And what are the advantages of SIP? It brings in discipline. It gives a power of compounding. It is convenient. You do not need to time the market. It can achieve your financial goals and you can invest according to your goal. And you can decide the amount as well as the frequency, and the amount can be as small as rupees 500 to as big as whatever you can invest. But what is the basic science behind the SIP? It is the rupee cost averaging. We will see what is rupee cost averaging. So how does it work? So you can see there are two types of investment, right? Either you do lump sum or you do in a staggered manner through SIP. Now assume that in January a lump sum investor invested 20,000 and in August the price of the security remains the same. So lump sum investor has no return. But a rupee cost average investor through SIP method, he invests more during the dips and less during the rises, and then eventually generates 7% return despite the value of the value of the security remain the same. So this is the basic principle behind SIP investment. So three terminologies which I like to share here. One is the AUM. Any mutual fund house or who have a scheme, they have asset under management. Total amount of money they manage, that is the asset under management. The net asset value, that is the NAV. This is the unit of any mutual fund scheme. So suppose you invest 1 lakh rupees and the NAV of that fund is 250 rupees, you will be allotted 400 units. So NAV is the unit for any mutual fund investment. And the expense is obviously to manage money, they will have some expenses which will be incurred. And those expenses are mentioned as the total, as the ratio of the total scheme's net asset value. And that is called the expense ratio. So it is always expressed as a percentage. And whatever NAV we get at the end of the day is after deducting those expenses. So these three things are important to know. So these are basically the type of mutual fund schemes any fund house has. But what are important for us to know is equity, debt scheme and hybrid, which is a combination of equity and debt. So first we talk about the equity schemes, and these are the highlighted ones are important for us doctors. And how do they work? Like the large cap funds, they invest 80% of the money in large cap stocks. So what are the large cap stocks? First 100 companies of the Nifty 500. The mid cap and small cap, they respectively invest minimum 65% of the fund in the mid cap and small cap stocks. And stock 101 to 250 are mid cap and 250 to 500 are small cap stocks among the Nifty 500. And there are the multi-cap funds and the flexi-cap funds. Multi-cap funds, they invest 25% each in large, mid and small cap, while flexi-cap funds, they can vary their investment freely across market caps depending on the situation. There is also a trend of passive investing, while that is basically investing in index funds or ETFs which try to match the benchmark. So the principle behind active funds is they appoint a fund manager who has the target to beat the benchmark. While the passive funds, they just follow the benchmark and try to match it. But the advantage of passive funds is that the expenses are very low because the fund manager role is very limited. And because the expenses are low, sometimes they tend to do better even than the active funds. What about ELSS? This is a tax-saving instrument while getting exposure to equity investment. But there is a lock-in period of 3 years. You can get benefit up to 1.5 lakhs under ATC section. And you can start in a SIP manner and get the benefit of compounding, get the benefit of equity investment while having tax saving. So if we see the average of equity fund returns in last 10 years, from large cap to small cap, the return is obviously higher, but the risk also gradually increases. The range is from 15% to 23%. Then comes the debt mutual funds. Again, these highlighted ones, the liquid funds mainly are important as investors. Now, the principle behind debt investing you should know is that it is for capital protection, not capital appreciation. So, our main goal for debt investment, usually these are parking money for short term when the goal of the money you need for is a near term goal. And so, we do not expect very high return from debt fund investing. So we tend to select those with the least risk, like the liquid funds and the short duration funds. Again, the range of return is somewhere between 5 to 5.5%. These are just average. But again, you should remember these fund investment are for your short-term goals, and that will be discussed in detail in the next talk as well. And then there are the hybrid funds. These funds invest both in equity and debt, and this is a good infographic to understand what are hybrid funds. When the funds are conservative, they invest more in debt. Balanced funds have almost equal exposure to equity and debt, while aggressive funds invest more in equity. And dynamic, there is balance advantage. They tend to vary their investment according to market cycles. Again, if we see the last 5 years return, the aggressive funds have higher return because they have more exposure to equity, but obviously the risk is higher, while conservative funds have less return and less risk. So you need to balance your investment according to your time when the goal is supposed to reach. And so that will, again, the goal-based investing using these funds will be discussed in the next one. So in summary, there are equity, debt and hybrid. Now, all of these mutual fund schemes have two options. The option one is between direct and regular, and option two is between growth and dividend option. Now we need to understand both these options because whenever a distributor or you will come across any mutual fund scheme, you need to understand these two options. So first is whether you opt for regular or direct. I'll share you the difference. Now direct mutual fund, the investor is going directly to the fund house. While in a regular mutual fund plan, the investor goes to an advisor and advisor takes him to the fund house. So advisor charges a commission out of it. And because of that, if we see in the second table, while the fund, the investment and the duration remains same, because of the higher expense in the regular scheme, the eventual return decreases by about 20%. So that is why it is important to go through a direct plan. Again, I would here, the other option is between growth and dividend. Now, since as doctors we do not need any regular income from our mutual fund investment, we do not go for dividend option. We go always for the growth option. Now, how to understand what is a mutual fund name? Now, Shakespeare said, "What's in the name?" But it's in mutual fund parlance, everything is in the name. So, if we see and the HDFC balance advantage regular IDC stability. So, what does that mean? The HDFC is the fund house, balance advantage is the hybrid scheme. Regular is between regular and direct, it's a regular scheme, and IDCW is a dividend option. So, but we are always supposed to opt for the fund which is direct and growth. You can select any fund house any scheme, that is fine, that's according to your goals, but always go for the direct option and growth option, especially when you're going for the equity scheme. Now, when you do any investment, Government of India is always a partner. So taxes are inevitable, but they have simplified it since last budget. So if it's an equity scheme, according to the holding period, if it's a long term, that is more than 1 year, the tax rate is on capital gains is 12.5% without indexation after an initial exemption of 1.25 lakhs. And for short term, less than 1 year, it is 20% the tax rate. Well, for the debt scheme, it is according to your income tax slab, irrespective of your holding period. So again, what are the principles of mutual fund investment? The practices we are going to discuss. So they are very convenient vehicles of equity and debt investment, especially for doctors because we tend to be busy with our practice. Now, equity, debt and hybrid mutual funds, they can be chosen according to your time horizon, according to the goal, and that goal-based investing for longer term goals, equity, for short term goals, debt, and for medium term goals, hybrid. SIP method has multiple benefits, main being the discipline and the rupee cost averaging. And if you are investing in equity scheme, direct and growth option, that is the way to go. Thank you.